A business owner signs a lease on a second location. Sales are growing 15% a year. Profit is strong. The bank balance looks fine, so they commit. New facility, 3 technicians, 2 service vehicles, additional inventory. Somewhere between $180,000 and $220,000 in upfront and early stage costs. Sales grow exactly as expected, and 6 months later, they are drawing on a line of credit they never planned to use. Nothing went wrong. Revenue hit the target, they just ran out of cash. Because nobody modeled what growth was going to cost before they signed anything. That is not a bookkeeping failure. That is a decision gap. And there are 4 signs that tell you when your business needs one closed. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Most small business owners assume a CFO is something larger companies need. A $50 million company, maybe. A regional chain with a finance department, not a $2 million service business with a good bookkeeper and a CPA who handles taxes. That assumption is understandable, and it is also the thing that leaves owners making 6-figure decisions with the wrong financial tools. Here is the distinction that matters. A bookkeeper records what happened, an accountant ensures the records are accurate and compliant. Both functions are essential. Neither one tells you what is about to happen. When you are deciding whether to open a second location, take on new debt, make a key hire, or acquire another business, the question on the table is not what last month looked like. The question is what the next 6 months are going to cost and whether the business can actually carry it. That is a different function entirely, and it requires a different set of tools. For most businesses in the $1 to $5 million revenue range, a fractional CFO is how you get that function without paying for a full-time executive. There are 4 signs that tell you when you have crossed the threshold where the absence of that function starts to cost real money. Sign 1. Your finance function is looking backward. You have a bookkeeper, you get monthly financial statements, the numbers are accurate, and the reports arrive on time. By the time they land in your inbox, the month is already gone and the next decision is already in front of you. Monthly reporting tells you what happened. It does not tell you what is coming. The gap is not in the quality of the reporting. It is in what historical reporting alone cannot do. It cannot help you make a forward decision. If your only financial visibility is last month's profit and loss statement, you are navigating forward by looking in the rearview mirror. That works fine until the decisions get expensive enough to hurt. Sign 2. Your decisions are getting more expensive. There is a meaningful difference between adding 1 employee and opening a second location. One of those decisions is recoverable if the assumptions turn out to be wrong. The other commits cash, capacity, and operational complexity before a single dollar of new revenue arrives. A new location, major equipment, a debt refinance, a senior hire, each of these creates obligations that land on your cash flow immediately while the return comes months later. The bigger the commitment, the more expensive a wrong assumption becomes. This applies equally during an acquisition. Buyers often model the loan payment carefully and underestimate the working capital needed after closing, which is a different kind of cash problem, but the same underlying gap. What is missing in all of these situations is a model built from the actual numbers in the business that shows what the next 6 months look like if you make the move. Sign 3. Cash feels tighter than your profit suggests. The profit and loss statement shows profit. The bank account feels tighter than it should. This is not a mystery, and it is not a sign the business is in trouble. It is a working capital problem that almost every growing business hits. Here is the mechanism. When you expand, payroll increases the day you bring on new staff. Inventory increases the day you stock it. Equipment and vehicles require payments immediately. Your customers are still paying on 30 to 45-day terms. The revenue from all that new activity arrives weeks after the costs do. Growth accelerates the gap before it closes it. A 2025 study of small business cash reserves found that nearly 2/3 of small businesses carry less than 90 days of cash runway if revenue slows, and roughly 1 in 3 has less than 1 month. These are profitable businesses. They are not failing. They are running on thinner cash cushions than most owners realize, and a growth push is exactly when that cushion gets tested. Profit is an accounting result. Cash is reality. The two move on different timetables, and when they diverge far enough, a profitable business runs out of money. Sign 4. You cannot see 6 months ahead with any confidence. You know what last month looked like. You cannot state what your cash position will be in 6 months if you make the hire, sign the lease, or take on the debt. That uncertainty is the planning gap a fractional CFO closes. The deliverables are specific. A rolling cash forecast showing actual cash in and cash out by month. A financial model built on real operating assumptions, payroll timing, collections timing, debt service, seasonal variation. Scenario analysis that shows you the outcome if revenue comes in below projection or a major customer pays late. These are tools for deciding what to do next, not reports about what already happened. Let me show you what that looks like in a real deal. Go back to the HVAC owner. A fractional CFO working that expansion in advance would have modeled the revenue growth timing, the payroll increase by month, the working capital requirements, and the projected cash shortfall. They would have identified what financing needed to be in place before the first technician was hired, not after the line of credit was already drawn. The expansion still happens. The owner just enters it with a roadmap instead of a surprise. Here is what to take away from this. A bookkeeper records what happened. A fractional CFO models what is about to happen. These are not the same function, and one does not substitute for the other. A profitable business can run out of cash. Growth creates working capital needs that arrive before the revenue does, and most owners discover this during a growth push, not a downturn. Nearly 2/3 of small businesses have less than 90 days of cash runway. Knowing that number for your own business is not optional when you are about to make a major commitment. A fractional CFO typically costs between $3,000 and $12,000 a month, depending on scope, compared to $250,000 a year or more for a full-time executive. For a business doing $1 to $5 million in revenue, that comparison is worth doing. Think of this as a part-time hire, not an outside consultant. The right fractional CFO sits at the table where decisions get made, holds the financial model that backs those decisions, and is a working member of the leadership team. The trigger is not revenue size. The trigger is decision size. You do not hire a fractional CFO because your finances are complicated. You hire one when your decisions become too expensive to make without a financial roadmap. If this gave you something useful, subscribe below. There is more where this came from. Research the deal before you fund the deal.